Welcome to vTalkInsight, Risk Sentiment Daily for April 8th, 2026. Oil shock and AI optimism are pulling markets in opposite directions, leaving risk sentiment finely balanced and highly sensitive to headlines. Across global assets, the tone today is fragile and two-way rather than clearly risk-on or risk-off. On one side, the Middle East energy shock and escalating tensions around the Strait of Hormuz are driving classic defensive moves in rates and selected equities. On the other, AI-linked technology earnings, resilient credit markets, and steady headline indices suggest investors still believe the system can absorb a higher energy and inflation shock without tipping into outright crisis. Crude has effectively doubled since the start of the year, with physical barrels and refined products like jet fuel and diesel trading at steep premiums, while flows through the Strait of Hormuz remain heavily constrained. Yet broader equities have only slipped modestly. The S&P 500 most recently finished slightly higher, and volatility for stocks and foreign exchange sits well below the extremes seen in oil, pointing to underlying confidence or, perhaps, complacency. Credit spreads, especially in high yield, have tightened back toward recent lows, and demand for longer-dated S&P 500 hedges remains subdued, reinforcing the sense that investors do not see imminent systemic risk. At the same time, elevated equity risk premia, shallow market depth, and the record gap between energy volatility and calmer equity and FX pricing all signal a downside skew if either geopolitics or inflation surprise further. The result is a market that looks resilient on the surface, but is acutely vulnerable to a sharp repricing. The first major bearish driver is the Middle East energy shock and oil. Iran's partial closure of the Strait of Hormuz and use of the waterway as leverage have given it unprecedented control over global energy flows. Only a trickle of tankers, largely from regional players, is getting through, while explosions on Karg Island, blockades of liquefied natural gas carriers, and strikes on over 35 energy and desalination sites highlight how exposed physical infrastructure has become. Oil prices have effectively doubled since January, with West Texas Intermediate approaching $100 and scenario work pointing to average prices around $110 if the conflict persists. History suggests that kind of sustained move has often been followed by at least a 20% equity drawdown, and current estimates imply global growth could be cut from roughly 3% to near 2% if high prices endure. Because the damage is now as much about shipping and logistics as it is about production capacity, the environment feels binary. Any meaningful reopening of Hormuz could ease pressure quickly, but further hits to infrastructure would likely amplify volatility across energy, freight, and inflation-sensitive assets. Closely linked to the oil story is stagflation and renewed tightening risk. Recent U.S. surveys show rising input costs and falling employment, a combination that hints at higher inflation alongside a softer labor market. Headline consumer prices are expected to jump by about 1% month-on-month, with gasoline alone up nearly 23% over the latest reading and pushing the headline rate toward levels last seen after the Russia-Ukraine shock. Markets now expect a more hawkish bias from central banks, with the Federal Reserve minutes likely to sound firmer on inflation and officials signaling that further hikes are possible if price pressures do not ease. Scenario analysis suggests that if oil averages around $110 this year, inflation could re-accelerate enough to force both the Fed and the European Central Bank toward additional tightening, even as growth slows and recession risks rise. That backdrop raises the specter of a 70s-style stagflation episode for which policymakers and markets are poorly prepared, although some argue that if the oil shock undercuts growth quickly, the next meaningful policy move could eventually be cuts rather than hikes. A third bearish force comes from credit and liquidity vulnerabilities, most visibly in private credit. Semi-liquid vehicles are facing elevated withdrawal requests, with some managers estimating current queues at roughly double what has already been returned to investors. Firms such as Blue Owl have moved to limit redemptions, and the sector has never been fully tested through a classic credit cycle, raising questions about how these structures would behave if defaults rise materially. Stress is particularly acute in direct lending to software and other leveraged borrowers, where annual default rates around 15% and recovery values of only 10 to 20 cents on the dollar are being discussed. Liquidity is inherently thin in these vehicles, especially in periods of strain, which could surprise retail holders who assumed easy access to cash, and any disorderly unwind risks spilling over into broader credit markets, just as public high-yield spreads look tight and valuations expensive. At the same time, there is clear dispersion. Institutional heavy funds, such as some large Wall Street platforms, report far smaller redemption pressure, suggesting that investor mix and structure will play a critical role in how this vulnerability evolves. Offsetting some of these headwinds is AI-driven earnings and tech resilience. Samsung's latest quarter dramatically beat expectations, with close to 90% of operating profit coming from memory and underscoring how AI workloads are driving a powerful upcycle in compute and storage demand. At the same time, ARM's new AI-focused central processing unit, built by TSMC and already ordered by major clients such as Meta and SAP, is set to ship by year-end, signaling deep, forward visibility in data center spending. Elsewhere in the ecosystem, NVIDIA is still expected to finish the year stronger as so-called agentic AI ramps compute needs, while Broadcom's 5-year agreement to supply Google with tensor processing units highlights growing confidence in alternative AI hardware providers. On the software and model side, Anthropic's revenue run rate has jumped from around $9 billion to over $30 billion within months, illustrating rapid enterprise adoption even amid regulatory scrutiny. Together, these stories help explain why indices like the Nasdaq have strung together multiple up days and why investors continue to lean into AI infrastructure and enablers, even as they become more selective after instances where strong results, such as Samsung's, failed to push share prices higher. The second key support for sentiment is resilient equities and credit appetite. Despite a 100% rise in oil prices and highly visible geopolitical risks, global equity indices have only eased modestly, and the S&P 500 and Nasdaq have recently closed slightly higher on diplomatic headlines. Earnings expectations remain robust for the second half of the year, with energy companies driving upgrades and helping to offset margin pressure in consumer and transportation sectors. In credit, both U.S. and European high-yield spreads have tightened back to their lowest level since early March, supported by strong institutional demand and ample liquidity in primary markets. Options pricing 6 months out shows limited concern. Foreign exchange implied volatility is moderate, and demand for longer-dated S&P 500 hedges remains subdued, all of which indicates that many investors still view current shocks as manageable. The flip side is that equity risk premia are now approaching levels seen during the global financial crisis and 70s stagflation, implying room for a 5 to 10% index pullback if either inflation or geopolitics moves decisively against this benign base case. The final bullish driver is dry powder and cash on sidelines. Money market fund balances have climbed to roughly $7.8 to $8 trillion, reflecting both elevated caution and a substantial pool of latent buying power. Short-end treasury yields have edged lower on safe haven demand as equities and bonds whip around, underscoring a preference for liquidity while investors wait for more clarity on energy, inflation, and central bank reaction functions. Interestingly, Bitcoin has been relatively stable to slightly higher through recent geopolitical flare-ups, with realized volatility compressing from the 80 to 90% range toward 40%, suggesting a maturing market profile and an additional outlet for risk capital. For now, cautious positioning, shallow depth in listed markets, and persistent geopolitical uncertainty keep much of this cash on the sidelines. But any convincing de-escalation in the Middle East or evidence that the inflation spike is peaking could see some of that liquidity rotate back into risk assets, amplifying moves once a new narrative takes hold. To sum up, risk sentiment sits on a narrow ledge. A severe Middle East energy shock, rising stagflation fears, and emerging credit and liquidity strains are pulling markets toward a risk-off stance, while powerful AI-driven earnings, surprisingly resilient equities and credit, and record cash balances are preventing a broader capitulation. The key battle lines run through the Strait of Hormuz, upcoming inflation data, and the behavior of private and high-yield credit spreads. How those pieces evolve will determine whether today's fragile balance tips toward de-risking or a renewed chase for upside. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.